Hey everyone, welcome to your next Kenny's Clip. I wanted to give you an update, have a change to the portfolio as well as some updates on what's going on in the market. So first things first, real estate, mortgage rates are pushing well above 6.5 up to 6.7, maybe closer to 7 here. Backed off a little bit on Friday, but we're certainly in the 6.75 range or higher. And that's likely due from the war and the shortage of dollars and the overall strain for liquidity that the oil market creates with extra high oil prices. So the high oil prices are driving gold down, Bitcoin down, as well as some risks in the stock market down, and mortgage rates up, and global interest rates have been going up as a result. So this is not just a U.S. phenomenon, and it is something that's a struggle for the real estate market. July is looking a little softer than June was, and likely if we continue with this war, the struggles will persist in the real estate market. So prices are continuing to soften. We're seeing more foreclosures, more short sales. We're seeing investors continuing to start to liquidate more properties. The new housing bill that the government passed is really a nothing burger, but ultimately that will create a potential problem if we do have a major drop in real estate prices in the future and an oversupply of homes down the road as the baby boomers are retiring and or dying, and we have the millennials coming along. So anyway, that's much further in the future. We are seeing prices soften in the South and the West, and that's just continuing. And inventory's pretty similar this year, increasing a little bit in the Midwest and the Northeast where it's been really short. So the prices are starting to level out up there. I expect that they'll start to decline here over the next year or two as well, as we have a well overpriced real estate market relative to income, and that will correct itself somehow. So most likely with price drops. So that's it on real estate. Just the same old slow, frustrating market with only 4.1 million homes being sold a year. So anyway, when it comes to the stock market, the latest update is to sell that I have received from a couple indicators is to sell half of my allocation towards stocks. I plan to do that first thing on Monday or Monday sometime, and that would leave a 0% allocation in gold, a 0% allocation in Bitcoin, and a large portion in cash with only a half allocation in stock. So however you set up your portfolio, whether it's 25% cash, gold, Bitcoin, and stocks, whatever your allocation in stocks is, I'm taking that down by 50%, just because we do have some momentum indicators and some indicators of increased risks and internals in the market that are showing a sign of a potential downturn, and we never know how bad that downturn is. So we're trying to eliminate the left tail risk, which is the market going down 20, 30, 40, 50%. And that's why watching the market and getting out when the risks are higher is really a good idea, especially if you're older. And if you can eliminate that left tail, you don't want to sell at the bottom. And you're never going to buy back at the bottom, but when the momentum turns up, like our last buy signal, we've had a very good return on that since that buy signal back in, I think it was in April. So anyway, taking some money off the table here, and that there's a lot going on in the market. Interest rates going up is really going to affect the stocks valuation, as well as the world of private credit and private equity is still continuing to be a mess. We have a lot of a new information coming out on how it's affecting insurance companies. A lot of insurance companies that have come out in the last 5 years that are owned by private credit actually Apollo owns their own insurance company because they get to take in money, right? You get to bring in money and invest it, and then only when there's claims or someone dies or an annuity has to pay out or whatever it might be, do you have to pay it back out. So it's a great way to bring in capital, and more higher risk investments have been going into the insurance industry. Potentially a highly leveraged. I've read some stuff, 50 to 100 times leverage in some of these things, and in these private equity companies that have bought yoga studios and HVAC companies and your local yard pest control and accountant or lawyer or whatever. So they bought all these smaller businesses thinking that they can get a return on investment by saving, cost cutting, et cetera, and repackaging. And that's not turning out so well. And that's where we're in this private credit problem. As the cost of capital goes up, all these things start to become issues, just like commercial real estate's down 50, 60, 70% in value. Same with multifamily homes, 40, 50, 60% in value. On the builders are having, some of them are struggling, giving away 2, 3, 4 months free in rent. So all this stuff is happening. It's a slow train wreck. Whether it will turn into the actual crash that causes it to feed on itself, we don't know when that will happen, and it can happen, but we just follow the indicators that tell us when to get out when risks is higher. Because guess if you think that everything is safe because everybody, you can always buy the dip and to hold forever, that just doesn't necessarily work, especially the older you are. So if you were fully invested in investing in 2000, and it took 16 years for the NASDAQ to recover, to get even. 7 years for the S&P in some of the markets, and then guess what? Then you had the market financial crisis. So there are a lot of times that the market has a long time to recover. We haven't seen it in 20 years. But it could happen, and that's why you want to eliminate losing 30, 40, 50% in your portfolio, because you'd be better off not making as much on the upside and not capturing as much of the downside. So, and then getting back in when things turn back around. So with a system, that's the key. You got to have a system. You can't just use your gut, because your gut is almost always wrong. So this sell signal of half the stocks, it could be nothing, and it could be a false sell signal, and the market continues to go up, and that'd be great. We get back in when that clears back up, but the risks of it going down are substantially higher right now for various reasons. So anyway, the same things we're watching. No investments in Bitcoin, or although I do have some that's stashed away, a hodl type of stuff, but I wouldn't invest any now. Bitcoin started to hit the $68,000 resistance, and it just fell apart immediately. So not a good sign. And gold is holding at 4,000. Certainly interesting. If it can hold 4,000 and make a move higher, I have an assumption that our signals will go positive on gold. But with liquidity issues and all that, it's going to struggle. The dollar's been strong. Interest rates are higher. That's not a good gold market. So anyway, stay careful out there. Stay cool. It is a dangerous market with everything going on, all this cross financing. Like everybody's saying how wonderful the earnings are, and earnings in the stock market is up 30%. Well, it's all a sham. The earnings of one company, of Google, are high because of their investment in Anthropic. Well, Anthropic, because they have to put their assumed value of Anthropic into their earnings, and say they invested $100 million or at a $10 billion valuation, and now it's gone up 10x because supposedly Anthropic is worth $1 trillion. Well, they put that on their books. It's fake earnings. It's not real money. It's like your house. If your house doubles in value, you don't sell it. It's not actually money, right? Or you have a stock that goes from 100 to 200 or to 1,000. If you don't sell it at the top, it's not real money. Well, that's what's going into their earnings, which is accounting shenanigans. And then, Google is paying NVIDIA, and NVIDIA is investing in AMD and CoreWeave, and CoreWeave's buying products from NVIDIA. It is a cluster. It is a cross-invested circle of cross investments that will go sideways when the liquidity dries up. Don't know when that will be. There's starting to be some problems. the companies like Google and all those are starting to have to borrow money. They're not really able to raise money. It's getting harder to raise it in equity, and they're borrowing money. So anyway, it's not just actually Google was able to raise a lot of money with equity, but a lot of them are borrowing money. And we actually just had a ratings warning on Friday, I think it was from Moody's, regarding some of the financing of all this AI. So things are starting to get a little frayed. That's stuff that's happening. That doesn't mean that that's why we're selling stocks. We're selling stocks because the momentum and the indicators are saying to, not because of what seems to be going on, because what seems to be going on to be very deceptive. So who knows what will happen, but I'm cutting risk. So this is not financial advice, but that's what's going on in the market. And I'll update you if we have a final sale of the rest of our stocks allocation or any changes on any other allocations that I have in my portfolio. Anyway, stay safe out there. It's only 102 here in Colorado. Stay cool, and hopefully this summer will certainly turn to fall with some cooler temperatures and maybe actually some rain. See ya.